Should you incorporate your property business? In this video, I'm going to look at whether you should have a limited company in which you have your rental property business, or whether you should have it just in your name, or maybe yours and your partner's name. I'm going to look at the tax consequences and also some of the main cost differences in having a incorporated business or a not incorporated property business. I do regular updates on tax and accounting issues, so if you'd like to be kept up to date, then please subscribe to the channel, and if you press the like button it helps me and the channel, so please do that. So there is actually quite a fog of complexity with property and the decision that you need to make about whether to incorporate or not, and it is actually in many ways a very personal decision, and it depends on how many properties you've got and also your other income and how you share that income around your family. Try and identify the individual things that you need to look at. Let's first of all look at if you're not incorporated. So if you're not incorporated, it's nice and simple. You just have your property business to deal with. You have to do a tax return, and that's relatively simple. So the accounting fees are generally lower. Very often, normally, the banks charge a lower interest rate if the business in your name rather than through a company. But if you're a high rate taxpayer, you automatically pay high rate tax on your rental income. The interest can be partially disallowable for tax if you're a high rate taxpayer. It's the control over the high rate tax that can be a real problem. And in addition to all of that, if your income then goes over £50,000, you can lose your child benefit, so it's another tax. So if you compare that to a limited company, yeah, the costs are a little bit higher. You've got maybe more accounting fees, you've got more interest to pay very often. But the big advantage is that you can control when the income from the property business becomes your personal income. You can maybe share some of the income more easily around your family members, particularly if you get an alphabet share structure. I'm just going to have a little caveat there that if you put your children in as shareholders and you've got a buy-to-let business, it might affect them when they go on to buy a house themselves, because they might be considered to have a house and therefore have this 3% surcharge and lose their first time buyer benefits. So just be careful with it. But it's that avoidance of high rate tax that people are particularly interested in, because the high rate tax that you pay can gobble up all the cash profits. So that's the basics of why people incorporate as opposed to not incorporate. There is also just a little layer of complexity I'll put on top of that, which is capital gains tax. If you're going to own the properties for a very long time, the capital gains tax is I suppose the gain is going to be larger maybe, but it's less relevant because it's not something you're going to pay just now. But if you're in a limited company, then yeah, the company pays capital gains tax at the normal corporation tax rate, but then you've got to get the money out of the company, and that can mean that you get taxed again, so it can be a form of double taxation. It's not too bad if you're then going to reinvest the money that you receive into another property, or if you're going to slowly take that money out as you retire. But there can be a capital gains tax issue in a company, and don't forget that a company does not get a personal allowance. So an individual, so if you've got two individuals, maybe a husband and wife, that own a property, they both get a personal allowance for capital gains tax at £12,300. So they've got to make £24,600 of profit before they pay any capital gains tax. Very often the capital gains tax is higher, but it's on a much lower figure, and you don't have this double taxation problem of getting the money out of the company if you just own it personally. That layer of complexity means that if you're a high rate taxpayer, you've also got to consider how long you're going to own the properties for. If they're for a very long time, maybe not such a big thing. But this actually leads on very nicely to the next problem, which is when you're dealing with property, I would never advise anybody to own property for a short period of time. So you're thinking about investment that's going to be owned for a long period of time. And we just don't know what the tax system is going to be over that whole period. We do know that landlords have been hit with extra taxes, and we know that nobody's told me anyway that the extra taxes have now finished. They've done with landlords, and everybody's happy that they are taxed the right amount. So it could be that the more taxes come in later, and therefore we're setting up a structure, but we don't actually know what the tax system will be in the future. So we can only do the best we can with what we've got. So the reason that it's really important to get the structure right at the beginning is because it's really hard to change a structure. So if you've got multiple properties, in order to go from a sole trade to a limited company, now it is possible, if it is considered to be a business and you've got multiple properties, to incorporate it as a business, in which case you might not have to pay the stamp duty and you might not have to pay the capital gains tax as you transfer it into a limited company. But even then, it's not easy, because if you've got all these property mortgages and you've got different mortgages with different end dates when they're renewed, then trying to get that all aligned can make transferring it in the future very difficult. So it means that getting this right in the first place is really important, and thinking not only about your current circumstances but also your future circumstances and how you might be taxed in the future becomes really important. As I say, it is possible to get incorporation relief, in which case if you incorporate a business, so you create a company out of an existing business, then that's not generally a tax event, which it would be otherwise, because otherwise, if you don't get incorporation relief, then as you put properties into your company, then you might be subject to the stamp duty, the 3% stamp duty surcharge, and also you've got to conveyance it, so you've got the solicitor's fees. So there's a whole load of cost, capital gains tax, stamp duty. There's just a whole load of cost. So it's very rare that people are able to do that, and that's how the economics works. So again, I say, please think about not only your current circumstances but your future circumstances and your property strategy within that. So how can I distill this down into some sort of advice that you can work with? I mean, in terms of advising people, in order to advise people, I would have to sit down and work out your personal circumstances and then work something out from there. But in general terms, if you know that you're going to be basic rate taxpayer, so if you earn something like £30,000 a year, you've got £20,000 of headroom before you pay higher rate tax, and there's no way you're going to get that sort of income from your rental property because you've only got one, for example, then it would seem like, generally, without being too specific, it would seem like just owning it personally, or maybe personally with your spouse, is a really good way of doing it. If you're a high rate taxpayer, then the more properties you have, and the more you are definitely a high rate taxpayer, the more it is likely to be useful to be in a limited company, because firstly, because the more properties you have, the cost of having a limited company get diluted, and also the high rate tax is just makes the whole thing really, really expensive and can destroy the economics of your buy-to-let. But you do need to sit down and work it out. Speak to your mortgage broker, find out the interest rate in a company as opposed to having it in your own name, so you can do the sums properly. And these the interest rates do vary over time. So you know, maybe it's a 1% supplement if you're in a limited company at the moment, but it might be less or more in the future. And also you should look in, when you do that, you should think about how long you want to own the properties for, so you can just factor in a thought on the capital gains tax position. So there's quite a lot of things to think about, I'm sorry, but there just are. I would definitely advise you to you know, get your pen and paper or your spreadsheet out and just work out the economics, and it's something that we can help with as your accountant. I would, you know, just consider your own tax position, how many buy-to-lets you want, how long you want to own them, but also not only what your tax position is now, what it's likely to be in a number of years' time. So if you're a young professional and you're a basic rate taxpayer, you might aspire to be a high rate taxpayer in a relatively small number of years, as an example. So think about the future, think about what the aim and purpose of the portfolio is, and then I hope that you can get to some sensible answers and get to a structure that means that your costs are as low as they can, so that more and more of the money is kept for you and for your family. I hope that helps. If you've got any questions, then please put them in the comments below. So I hope you find that useful. If you would like to leave any comments, then please do that in the comments section. I will try and answer them within a couple of days anyway. But if there are more complicated questions that you've got, or personal questions that you've got, then please go onto our website. And if you fill in the contact form, that email will come directly through to me. Again, I do regular updates on tax and accounting, so if you'd like to be kept up to date, please subscribe to the channel, and if you press the like button, it does help me and the channel. Thank you very much.